All right, what's up, everybody? Oh God,
Everybody.
what is up,
Gee,
everybody?
just roll it. Just roll it.
We're just doing it live. Fuck it. Um,
Everybody.
what's going on, everybody? We got the Roundup edition of Forward Guidance, and for the first time in a few weeks, it's back to the trio. It's myself, Quinn, and Tyler. What's going on, guys? How's your week?
Okay.
End to the quarter. We're liking what we're seeing out there.
It was
Quinn-
so over, but we're so back now.
Quinn's also on his fourth wedding of the year. We're of the quarter. What was it?
Third of the month.
Oh, Jesus. Yeah.
Yeah, I don't think our listeners know that Quinn has just been in pretty much every different wedding venue across the entire world for half of these recordings through the summer.
You oughta this one's in Birmingham, Alabama. Look at what I'm wearing to commemorate.
R.I.P. the king.
Yeah, dude.
So you went from France to Birmingham, Alabama. That might be the only person in history to do that transition.
That's a crazy
Hey.
friend group you have.
Hey, get you your mans who can do both, you know?
Yep. Love it.
Yeah, me too. Man, it's been a big week for bazookas from the central banks. China has been the leader of it. So if you guys remember a few weeks ago, we brought up this chart and we started to really talk a bit about how China is seriously deteriorating, and it was looking like it was going to be the canary in the coal mine. And this is just looking at nominal GDP of China, which, you know, they typically try to target on this long-term forecast of 5%. And just looking at the M1 money supply of the yuan in like 6 months forward, looked like it was about to drop off a cliff. This got a lot of people worried. And then even just looking at this chart, I thought was really good at just showing just how below trend China's growth has been since the end of COVID. They didn't really recover like, you know, the US did as much. They've sort of just been below trend and stagnated quite substantially. You know, Jack, in one of his last episodes on here, had Richard Koo on the podcast where he talked a bit and explained this idea of a balance sheet recession and how China is actually in one right now. And a lot of that has to do with just the amount of that debt has been piled up and that is having to be focused in terms of being paid off, and just how difficult that is to stimulate in that kind of a environment. So that's all been happening. We've been talking a bit about it on the show. And what happened is that finally, and you know, this is my big speculation, is people were wondering, why isn't China stimulating significantly? Things are really, you know, falling apart. We're just starting to see a deflationary spiral. Just so happens a few days after the Fed starts cutting rates, starting off at 50 bips, the bazookas start to come out. First off, you know, maybe it just came out as an RPG, but we started to move up into the bazooka land. So the first thing that came out was the China head of the central bank, Pen Gongsheng, came out and just basically, you know, did as much as the monetary side could do. So, you know, cut rates by 50 basis points, cut mortgage rates, basically tried to increase as much and promote as much lending as possible. And that was a good start. But really, again, with this dynamic of a balance sheet recession, which I'm not smart enough to explain compared to somebody like Richard Koo, so go watch that episode if you want to learn more about that. But we started to, you know, see these more fiscal stimulus type of things come out. So we got this where they're basically planning to and considering of just basically giving out fiscal stimmies, which just seems to be the thing to do these days. Is just to literally, you know, have helicopter money. So, you know, there's plans to basically give out helicopter money to individuals, and overall, things are coming out. You know, there's you know, $500 billion in facilities being set up to buy Chinese stocks. There's you know, $140 billion, I believe, being set up to inject into the top banks. There's a lot of things. You know, we can get into the nuance of, you know, whether it's a technical adjustment or not. I really love this meme from Citrini that he posted the other day. You know, just call a spade a spade. We got a lot of Chinese easing coming down as it stands here. So lots happening. I wanna get how you guys are reading this. To me, it seems pretty clear that, you know, the bazookas are starting to fire off. You know, I definitely agree that we may need more, but it's clear where their head is at. And now that, you know, Powell is eased, they've basically gotten the green light to just do as much as they can right now.
We've talked about China the amount, and I think that's kind of my take, is like everyone's been questioning, you know, why, like pointing to China as this like horrendous nightmare situation, which for all the problems they have, yeah, it's their economy hasn't been great, but it's simply because they're now competing with the dollar and treasury market for a global reserve currency. It this deglobalization is where the U.S. weaponizes the dollar to remove, basically confiscate Russia's reserves. Has created a multipolar geopolitical environment, and so China, for them, it's an opportunity to capture some of that, uh, let's say, market share for this store of value away from the dollar and treasury market. And to do that, they've sacrificed, fiscal irresponsibility, like the US has gone full bore at, in order to make their bond market the best performing bond market in the world and not sacrifice their currency. And so this whole time they've weathered extraordinary economic pain to make sure their currency stays strong. And now that the Fed, just in the same way that BOJ has taken their foot off the hiking gas after the Fed dovishness, now China's doing the same. And look at, I tweeted this earlier. The most interesting thing of the week is the CNY, Chinese currency, strengthening against the dollar on these moves. So it's basically the market saying, "Wow, good on you, China, for holding out from irresponsible fiscal action and monetary action for literally since COVID, 3+ years, and now you're doing this, stimulus action today. You're going out strong. You're nipping this in the butt, and you're doing it at an opportune time post Fed, when the Fed's probably going to do another 50 in November." So it's like, and then you have people like kind of, poo-pooing the quantum of the stimulus. And this is about as close to a whatever it takes moment as you could have, like daily communication on new rollouts. And then to top it off, you had David Tepper on CNBC this morning, which was a mirror image of him in 2010, or was it 2009 or whatever, after the GFC, saying, buy stocks. Like the central authorities are telling you they're going to do everything possible to pump the stock market. Don't overthink it. And so to me, that was just like icing on the cake.
I'll let you get in there, Tyler, for a second, but I just want to say I totally agree that it definitely feels like a Mario Draghi whatever it takes moment. They're like, we'll throw 500 billion won at it, and if that's not enough, we'll just throw another one. And so it's like, okay, like it's clear where their head is at. They're just trying to gauge, what is required to create that confidence. It reminds me a lot of March 2020 when the Fed cut to the zero bound overnight, and we kept dumping, and people said, "Oh my God, the Fed has lost control. They can't get under this thing." And you just got to wait for these facilities to roll out. Then they started to say they're going to buy corporate bonds if they need to, and they got underneath it. Just give it a little time. These things roll out. Chinese equities are definitely reacting positively, so it's clear what's happening. Tyler, what's your read on this?
Geez, I think the world is changing before our very eyes, and I'd like to go through a couple just slides. Slide Neville here. If you go to slide 51,
The professor.
this is the Asian dollar index. Now, we talked about this a month or two ago, three months ago, when it was at 90. And I think we were all saying, watch out, there could be a global credit crisis if this breaks. And inevitably, what happened, the world controllers, the central planners came in, and they essentially weakened the dollar. And now go to slide 50. This is the global liquidity cycle from Mike Howell. We're on the same path as the 1985 Plaza Accord, where we weakened the dollar massively. And I think the same sort of thing happened behind closed doors with China. Is they went to Yellen and they said, "We're imploding here. You need to let out dollar liquidity," which is exactly what happened behind closed doors. And everything kind of, we were seeing China's deflation benefit us now, right? Because the Chinese 10-year yield, I think, is at like 2.2, and that's allowing us to ease here. So essentially, we're in the same sort of situation as the 1998 Asian financial crisis, where the disinflationary pressures of the rest of the world is allowing our Federal Reserve to ease rates. And you can see that in the forward break evens that we talk about every week. Even today, break evens are at 0.7, US break evens 1 year out are at 70 basis points. So this is incredible. China just pulled out an absolute bazooka, and oil's at $67 barrel. So what exactly is happening here? I think what's happening is, the world is going from centralization to decentralization. This is very like high level. You don't even have to show that any more charts on this. This is just me ranting. But I think the past 40 years was about two hegemons rising. You had the US and China. China was a hegemon of manufacturing. That allowed us, massively disinflationary pressures to build up our US tech hegemon. So those two things were symbiotic for the past 40 years. Now what we're seeing is a breakage. And what's happening is we're probably going to import. We want to build our manufacturing sector because we don't want to just be centralized in just US tech. We don't want to be the Saudi Arabia of US tech. Saudi Arabia, meanwhile, doesn't want to be just the Saudi Arabia of oil. So we're watching like really interesting moves. One really interesting point was if you go to slide 53, the biggest banks in the world just said after the 3 Mile Island, they said they're going to pledge support for nuclear power because this is the decentralization of the energy supply chains. If we do nuclear power now, the next day Saudi Arabia comes out and is like, oh my God, we're going to pump more oil. So we could potentially be in this weird world where massive fiscal stimulus happens in all these markets because the world's engine is slowing of growth. And if you have a decentralized energy supply chain, meaning, nuclear power, wind, solar, oil, all these things are naturally disinflationary. And if every country adopts, a diversified source of energy, it could be that we can really pump the steroids on fiat currency, whether it's fiscal or monetary, and you kind of work your way out of this. Like it's kind of a weird because you default to, oh my God, they're going to print a lot of money. There's going to be inflation, but oil's down. So something different is happening.
So oil is down. You're right. It's at 67. But if we just look at like copper, Dr. Copper, it's surging.
Yeah,
How do
metals.
you think you square those two things?
Because I think China's fiscal is going. This is the Saudi Arabia effect.
Mm-hmm.
They're going to try and rebuild their economy, and a lot of that's going to go to metals and mining. Those are actually
Yeah.
doing quite well, and I think there's a lot. The supply and demand is way different. Oil's supply and demand is really funky because we are now the largest producer of oil, and I think Quinn has a lot of charts on this. But when you have everyone pumping, and not only that, but financing costs are getting easier to pump oil. It's almost like this. I said last week, Mark Andreessen, technology is doing more and more with less and less. And commoditized goods, they're commodities for a reason because everyone can produce them. So we could be seeing what I'm trying to get at is OPEC could be breaking up here. If it turns into a kind of everyone pumps and you get Trump in and he wants to pump more and more and the financing costs are advantageous to pump more, you get into like this self-reinforcing game of oil prices lower. Now, I'm not an energy expert. I'm just talking macro here of what I'm seeing in the price reaction to a large Chinese stimulus. And it's kind of odd that we didn't see a pump in oil after that.
It is. There was a brief one. My only critique, Tyler, and because you always correct my accent, is it's
Yeah.
China, not China, China.
My bad.
My take, I'm an oil bull here. At least I'm an oil bull insofar as it hedges my digital assets because the lower oil goes, the lower inflation vibes are, and the more they can print, and the higher Bitcoin, et cetera, can go. But I think personally that there's still this recessionary vibe. I look across like the macro universe, and it's despite this bazooka stimulus, there's still this huge recession wall of worry, deteriorating labor market concern. Like I don't think that's left, and I think there's remnants of selling uh, recessionary cyclicals like oil to fund your. I think there's a bit of an algo thing. I mean, you look at these. That Saudi headline is kind of. I don't really read into it too much. Like it reminds me of when
This
Reuters.
one, Quinn?
Yeah, it reminds me when Reuters leaked from their sources in the summer that OPEC wasn't going to extend the cut. And then the following, oil's down 3. The following day, the exact same sources say they are going to extend the cut, and like oil's right back. So I just think there's this kind of hangover on the recession vibes that, and if you think about it, right, these stimulus rate cuts work quicker in the financial asset markets than they do in the real economy. And ultimately, if they are going to be effective, they're going to reinvigorate the economies and oil will increase. I believe in everything you're saying, Tyler, but I think that that transition will not be as quick as 6 months to, you know.
Yeah. I think there's a lot of confusion in the markets. And like you say, this recessionary vibes thing. And, all three of us are kind of pretty strongly in the anti-recession camp. So I've been trying my hardest to understand like what is the argument. And I just have a few slides I want to talk a bit about in terms of the labor market side of things. What are you laughing at, Quinn?
I was
I'm
like,
just
Tyler,
I'm laughing at the fact that, like, I look every day in industrial stocks go to new highs,
Yeah.
and there's a bunch of different sectors just keep ripping, and people calling for recession. And then I look at the fixed income market, and there's no sign of stress there every single week, and
I know.
the sentiment hasn't changed. And we get a lot of comments in these videos. People are like, "You're just too young to understand. I can't believe you." And I'm like, I'll take the contract until I see credit spreads blow out. I'm going to stay like long this
Yeah.
bull.
Same. But okay. So let's walk through the labor market because that's the big one that people are looking at for understanding if there's a recession. So for those that don't understand what this chart is, this is the Beveridge curve. It's one of those fancy curves that's named after a fancy economist, and people at the Fed and with their PhDs look at it. And basically what it shows is the job vacancy rate. So as measured by the JOLTS data or the job openings data versus unemployment rate. And so Chris Waller, who is one of the governors at the Fed, has been talking a lot about this dynamic of how to actually achieve this soft landing. He talked about this first in 2022, and he had an update to it earlier in the year where he talked about how, in his analysis, the vacancy rate can get down to 4.5% before we see a meaningful increase in the unemployment rate. So effectively, they can fight inflation and try to tighten as much as they can until the job vacancy reaches that 4.5%. And then that's where they see that buffer running out and seeing this unemployment rate kind of increase. So you can see this hasn't been updated with the August data, but we're basically at 4.6% right now in the vacancy rate. And so when you think about this, that is just a 10 basis points above the 4.5 level. And oh look, like the FOMC has just gone ridiculously dovish. They're throwing 50 basis clips, and there's another 50 basis point cut priced in November. And this is the game at hand here: is that they have seen, and so far it's been bang on. Like Chris Waller has been bang on this. Is that you can tighten up until that 4.5% without getting this huge increase in the unemployment rate. We've seen a bit of an increase in the unemployment rate, but it's difficult to see if how much of that is because of labor supply increase. But overall, like this is the path that the Fed sees for the soft landing. So that's the soft landing argument. There's been some interesting survey data. So this was the consumer conference board data survey that came out a couple of days ago, and one component of that is just basically confidence in getting a job, as measured by the labor market differential. And basically what this shows is that based on confidence in the survey, the unemployment rate should be heading meaningfully higher here. Now the issue is is that these surveys have been really wrong this cycle. And this was actually a really interesting chart from Bob Elliott that just showed how politicized these consumer sentiment surveys have become, especially a month and a half before a recession, or sorry, before an election. Maybe that was a Freudian slip. We'll see. But look, these soft data points have been extremely noisy this cycle, and I think a lot of it has to do with just how politicized things have become. Okay, so a couple more slides, and then I'll pause and we can chat about this a bit more. But initial jobless claims, which is one of the most high frequency data points we can get in the labor market, has just been in a down only trend, and just missing expectations to the downside. So less jobless claims than forecasted. So this came out today at 218,000 versus the consensus 225. And just looking in the big picture, this is from Jim Bianco, just looking at like the rolling 4-week average. we need to be seeing this going higher meaningfully. If you're a subscriber to the SOM rule and you think we're in an early stage of a recession, this should be soaring. Yes, it peaks out at the end stage of a recession, but regardless, we should not be at these huge lows that we're seeing right now. Now, the last argument I want to make here is, okay, there's this argument out there from people that believe that we are in a recession, that people don't want to go register for initial jobless claims because they'd rather just go work at Uber or DoorDash and deliver there, so they're not registering because they can make more money there. But you would see this show up in this chart from Fred showing employment level for part-time for economic reasons, and we're not seeing that. So I dug in pretty deep on the labor market data this week, and I just don't see it. And the Fed is highly attentive based on what we just looked at in the beverage curve, that they're just going to ease as hard as they can now that we reached this 4.5% level in the vacancy rate. So if we're not seeing it right now, and by the time we get into the middle of next year, we're going to have quite a few rate cuts underneath our belt here. Like, what's the recession argument?
I want to just point something out that is just, if you're not a believer in the centralization, and you could call it corruption, maybe people take a negative connotation, but the controlling of this whole system, you're just not thinking hard enough. So I'm looking at a headline right now. Illegal border crossings fell in July to lowest levels in 4 years. This is talking the southern border apprehensions. And a big part of this labor market, quote unquote, weakness is, an increasing labor force from foreign-born workers, which this whole time, this whole political open border policy, and this is objective, was to suppress wage inflation. And that's it. The politicians are never going to say, it's in the same way the Fed's never going to say their new target is 3%. The politicians are never going to say, we're going to sacrifice the lower income in this country, increase competition and immigration to take those jobs, to suppress the lower and middle income wages, to get inflation down. They're never going to say that, but that's exactly what's going on.
I think Powell said that last meeting.
Yeah, well, the Fed has acknowledged it. The Fed and Treasury have acknowledged it, but the clowns running the country won't. So you just, and now all of a sudden, when all the slack is gone out of the labor market, isn't it just so strange? What a coincidence that the border is now tightening up. And we're headed into a consequential election where, supposedly the existing administration has all the, the newfound keys to solving the border crisis. Like, these things are not coincidences at all. And then, the other funny thing is we're going to get another messed up month in September, October on, this new hurricane data. And so that's going to just be another great data point for the Fed to, it was, maybe it was one-time weather, maybe it wasn't, but more reason to cut. Like, it's all just part of the game.
What's up, everybody? Just want to take a second out of the show to talk about the next major Blockworks conference that's happening. Permissionless 3 is a leading crypto conference, and it's going to be happening in Salt Lake City this year from October 9th to 11th. There's going to be some major legendary speakers there from the likes of Balaji, Chris Dixon, and macro veterans like Dan Teffiaro will also be there. Not only that, but we're also going to be doing a live recording of the weekly Roundup Guys Emporium edition. So you can come meet myself and Tyler and Quinn, and even Mike will be there. If you're interested, we have a discount code. Use that and you'll get 10% off as well. So I hope to see you there and that we can catch up. All right, back to the show.
Well, here's my thing about all the data. Well, first of all, Felix, that was a masterclass in data analysis.
Thanks,
I do love it. And incrementally, it's great. But
yeah,
part of me wonders what's not taken into account. This is horrible, but OnlyFans reported $6.63 billion in creator payouts. And what part of the economy is that showing up in? Are those part-time workers? And how does that factor into the gig economy? There's so much other stuff going on nowadays with where you can make money that maybe it's not showing up in the unemployment data. I just, on average, on trend, I kind of enjoy looking at the data, but it's so much more complicated than that. And I take stock price as the holy grail. That's what.
Exactly. Like credit spreads will tell us if there's an actual concern here. I fully agree. I just, I got to go try and do that work to prove it out because we got to try because that's a lot of the narrative on the recession side. And I'm sorry, I don't see it.
I think the thing that people get hung up on is we talked about it before, but it's like this argument about what I think is right, what the Fed thinks is right, and what
Yeah.
they should do. And these can all be different
Yes.
things. Like
Yes.
like they're going to depreciate the currency and paint whatever picture they need to be able to do that and support the markets going into an election, trying to maintain their incumbency, support the economy at an aggregate headline level, so that they're not at the helm of a big recession. So like
Yeah, I don't
it's
even
just
think it's I don't even think it's political. Like I used to be like that where they're gonna juice the economy. I think they just got lucky because they really tightened fast and China they caused China to bend the knee. And now
Yeah.
that allows them to ease because like
I mean,
global
look at Australia. They can't cut yet because they're too slow to hike. So now they're still not dovish yet. They're more likely to hike still than cut because they have a really bad inflation problem, and that economy is quite similar to Canada. But we actually got underneath it and hiked significantly, and now we can cut significantly.
where I'll agree with you is like if you look at the was it the reverse repos coming down, like they're doing the fiscal push. Probably that's where you could say it's a little more political. But I don't know. Powell really has, if you're looking at what they look at, I think it's less political. I mean, Trump would be, you know, easing massively if he was in office too, I think. What's crazy is, stock prices are at all-time highs and they're beginning an easing cycle. And we're just in Weimar, Germany. Like, the funniest thing to me is that everyone just keeps calling for a recession. We might have stock prices go up in a recession. Like, the next generation is just going to be printing so much money. It's a global fiscal super cycle. That's what we're looking at here.
I mean, today's GDP print, it's like 3%, basically. I
Yeah,
mean,
I want to talk a bit about this because okay, so I got the revised data here. So that was at 3%, and I want to talk a little bit about this because so on a in a normal model, GDP equals GDI. They're just measuring different sides of the balance sheet. One is output, one is income. So they should, generally speaking, meet somewhere in the middle. Last quarter, during the previous estimate, GDI, so gross domestic income, was at 1.3%, while real GDP was at 3%. And so what started to come out was there was a bunch of people saying, oh, at the turns of the economy right before a recession, GDI leads GDP. So GDP is overstated right now, and it's going to be coming lower to that 1.3%. Oh my God, we're on the verge of a recession. The exact opposite happened. GDI got revised higher to 3.4% to match GDP. So here's that shown in chart. And it just goes to show, like, suddenly this became the narrative that shifted for the recession is, oh, look, GDI is the real number. So okay, GDI is a real number, perfect, it just got revised higher to match GDP. How is that recessionary? And at the same time, that also changed the personal savings rate. People were saying, oh, the consumer's tapped out, look at how low it is, it's cyclically low, they have no more money to spend. That got revised higher significantly today too. So this is just it in chart form. Is you can see this was before the data, before the revision came out, and you can see the miss in GDI. And now with the revision, it's actually above GDP. So yeah, you can pick and choose your data points, but when I look at everything like this, and now these revisions that this was the recession argument, and that just got revised higher. What else is there?
You know what I think? Richard Koo brought this point up, but China's in a balance sheet recession, and he says, just to rehash it, if you have $1,000 in GDP and you save 10% of it, you save $100, and 900 goes into the economy and you spend it. That $100 that you save in a growing economy is a borrower. A borrower borrows that $100 and goes and spends it. So you have $1,000 in GDP total from that borrower. What happens in the balance sheet recession is that $100 goes to pay down debt. So your $1,000 GDP economy drops to 900, and so the government needs to make up that $100 of spending, right? And so that's China, right? But Now they're turning on the spigots. That fiscal impulse to make up that $100 of spending is getting back into the global M2, right? The reason why the stock market keeps going higher in the US is because we've already delevered our economy in a not from the sovereign balance sheet, but from the corporate balance sheet. So now in what they're doing is yield curve control. Yellen's been a master at issuing on the front end and not on the back end to cause, some sort of credit shock. We're in centrally planned economies. And now you're going to get global M2 rocking, and that should kick off I don't know, I think a pretty self-fulfilling like global GDP growth. So as long as oil stays at bay and other inflation doesn't get too crazy, we could be in kind of just a putz along nominal GDP growth here. So I'm in the non-recessionary camp, obviously.
We printed a 5.5% nominal GDP growth. And why in the world are we even talking about recession? Next topic. This is ridiculous.
Yeah, I mean,
Because
look,
it gets headlines, dude. I wish I was.
Yeah.
I wish
I know.
I just like
Well,
followers.
you know what it is that people have been attributing too much to things like the yield curve inversion. And, there's been some great work done on this by guys like George Robertson, Danny Dayan, Michael Howell. They've all done their own models of this. And there's issues in signal in the long end of the yield curve. And it gets back to Tyler's point about, this form of yield curve control. I would argue 100%. We have an artificially low long bond yield, and that's skewing the signals we get in terms of yield curve inversions. I think that's throwing a ton of people off.
Yeah, first principles thinking is tough,
At some point, the inflation will come, and when you see China's 10-year yield actually start rising, look, the yuan usually when it strengthens, you see global inflationary pressures increase. We haven't seen that yet, so they're not doing enough fiscal. When they do enough fiscal and they issue enough bonds to get things stewing there again, we'll adjust. We're not like dumb and just like perma bulls here. We'll adjust our story, but right now it's like Goldilocks.
Okay, let's switch gears here. You mentioned global M2. That's a great segue into some interesting work that I actually saw Lynn Alden post the other week or the other day, actually, just looking at correlations between different asset classes and growth in global M2. And so this really gets into why us as macro first analysts are big fans of crypto and Bitcoin. Is this just looks at the rolling correlation and directional alignment of Bitcoin and other asset classes to changes in global M2. And basically for 83% of the move in global liquidity, Bitcoin essentially captures 83% of it, which is the most of any asset class. So it's the most sensitive to changes in global liquidity on an average 12-month rolling correlation, 0.51. So, a decent positive correlation, but it would be a lot higher if it wasn't for Bitcoin. Is a lot of it gets held up by a lot of these idiosyncratic events like we just experienced this past summer where global liquidity was rising and gold setting new all-time highs every day right now, but Bitcoin has been down because of things like the Mt. Gox selling, just over leveraged degens and perps, German government selling and that sort of thing. So this to me is why it's the asset to express your views on global liquidity.
Yeah, there's one trade. There's only one trade.
Yeah, it's all one trade now, and that's why we were talking a bit about this off camera before we jumped on. It's just looking at like earnings multiples as like a signal for equities, and it gets into a little bit what I talked about last week about how I'm a lot more bullish on gold and Bitcoin because they don't have cash flows versus equities. Quinn, you had a good explanation of that. Do you want to unpack that around just like how you're viewing multiples at this stage?
Basically, I had a conversation yesterday with a group who, that was the kind of one of the bigger risks on their mind was multiples being rich, and they are rich. It's like 25 times trailing. I think like low 20s on a forward, but like go back, and again, this isn't normal history, but 2020 to 2021 is an example of a similar amount of market manipulation, treasury, monetary intervention that we're seeing today, I would argue. And there's almost a 2-year full stretch of extremely elevated multiples. So, uh, you know, I think it like we saw in the August deleveraging and we saw in the September jobs report scare, the equity dips have gotten scooped like nobody's business. And the takeaway from that, plus this global bazooka, is these central banks are cutting and stimulating massively into 3% bottom trough inflation. And so if you're, a market practitioner that's saying like, okay, that's going to do something. It's not going to make inflation go down. We're probably looking at maybe a reignition to like 4 or 5% from here. Earnings are nominal numbers. The economy's fine. It's going to reignite. Yeah, expectations are high and growth is strong, but it very well could improve from here. And I'm not saying that equities are the bargain of a lifetime, but I'm saying that when you have the central authorities doing what they're doing and telling you we're going to do, China said we're going to do everything possible to make sure stocks don't go down. They just said that, like, translated to that. Like, that's why multiples are going to stay elevated. And so, like, it's not like bull markets don't die of old age; they die of something that causes those to come down. And the last point on that is crypto has always had its best, Bitcoin and crypto performance in the last portions of the liquidity cycles when equities are elevated. So think about this. Here's a zoomed out, like, dumb brain example. I'm an investor and I see equity multiples say I believe like 10 to 15% from here, and we're at like peak valuations. Okay, cool. So that's not that great. But I see the economy strong. I see the central banks stimulating like crazy. But I know stocks are expensive, but I need to allocate capital because yields on my fixed income portfolio just came down, 50 base points and another 50 next month. What do? I'm going to go out the risk curve into crypto. So the liquidity spice is flowing. I'm not going to bid equities to pico all-time high multiples because that is a little too ridiculous. So I'm going to go out the risk curve into Bitcoin and then crypto and more speculative assets where I can hopefully achieve a higher rate of return that makes up for the falling risk-free rate. And that's why you get these periods where liquidity cycles booming, economy's booming, and people speculate on longer tail risk assets, and that's the environment we're entering.
Yeah, and the other thing to add to that is, yes, some stocks are expensive, but there's other stocks that aren't expensive. And in the easing cycle, you could very well see the rotation into those stocks, which I think we do. I brought up Carvana like a gazillion times, but that's expensive. But it's more of a sign that underneath the fangs, a lot of rotation is happening. Like I brought up space stocks; those are rocking. And there's a lot of things that are changing underneath relative to large cap tech.
Yeah, the other point I'd make on that, just give some love to the bears, so people just don't say we're 20-year-old moon boys.
Yeah.
Is yes, it's an if then probabilistic thinking that you need to be using. Yes, multiples are elevated. So if there's a problem, then there is more room to correct, right? Like if multiples were at 15 and the problem comes up, like whatever, like, stocks kind of usually have a floor in valuation somewhere, so it's a if then thinking. But if things are cooking and the economy's fine and central banks are getting easier by order of magnitude, then we're more likely to stay in a supported regime. And I would just say, probably put this in the back of your mind for 3 to 4 months or 3 to 6 months. But everything appears very calm on the surface. Oil's cooperating, yields are down and cooperating, the economy's fine, geopolitical stuff, despite every week a new headline of more missiles being sent to another, war site, that's very calm. But what I would not describe as calm is the second and third largest global stock markets having minus 10% day in August with Japan, and a plus 10% day in September with China. Uh, that is not calm under the surface. So while everything looks great and rosy, there is stuff that's like Tyler's mentioning, these big picture shifts in you know, what the kind of like rule of order and stuff. There are shifts happening, and there's going to be a day where you're going to want to be really concerned about it. Um, but that's just not today, and you got to kind of dance when the music's playing.
Yeah, I mean, I feel like the bigger thing to be worried about is if we get to a point where central banks start to lose control of the long bond, and that's really the key fear of mine, at least. I mean, look at what's happened on TLT versus gold every day since the Fed meeting. TLT is down and gold is up.
I got a great chart on tangent to this once you finish.
Yeah. I mean, that's the main point, honestly. It's just like that's what the market is telling you right now. And we're getting 50 basis cuts at the last meeting. That's what's priced in as the most likely outcome for the November meeting. So they're getting underneath this. So, okay, the way my simple framework, and I'll let you go on this, Tyler, is that, okay, if the Fed is late, then yes, their 50 basis cuts are not going to save things in time, but they will a year from now probably is when there's going to be that meaningful impact. But when we look at all the labor market data that I just went through, that says that, okay, if you're a Psalm rule believer, and that means we're in the early innings of a recession, that labor market data should be way worse than it is. Yes, 5% of it, you can argue something about it being bad. But again, I want to look at the aggregate data. So 95% of it tells me that things are fine. So if that's true and they're cutting right now, then that, basically floor falling beneath you risk, I feel like, is very low. And they're already, as the market is telling us, with gold going higher every day and long bond yields going higher every day, is they've already, cut the tail risk quite significantly. And so I don't know how you could get a recession a year from now if we're not in one right now, if they're already easing this much.
Agreed. The chart I was going to show is slide 52. This is kind of just an interesting macro take. Uh, so this is the debt. This is a great chart from Incrementum. U.S. debt held by foreign banks on the left-hand side as a percentage of total debt, and then central bank holdings of gold as a percentage of currency reserves going up. And so this is really interesting just from a global collateral standpoint. Less and less foreign banks are holding our treasuries, and more are holding gold, which is why gold's been going up every single day. And just to hammer home that point about cheap stocks, this is just don't own it. But Kinross Gold's growing at almost 40% this year, and it trades at a 16 times PE relative to like the tech sector. And think about that. The rotation you could see into different, forms of collateral is really interesting. I think to this point, Bitcoin today was interesting because Bitcoin was up and the Qs weren't up as much. And if
Mm-hmm.
Bitcoin becomes global collateral similar to gold, as people stop holding treasury bonds, that could set off just this like realization. And the Fed will probably have to do, once they lose foreign buyers of US treasuries, they're going to have to do more and more QE or, the yield curve control or
Yeah.
fiscal MMT type things. And that's just the natural cycle of our generation taking over. The boomers have completely ruined, the finances of the country, and we'll have to paper over it. And that's the end game here. And we're seeing just by pure gold, this should be a sign that something has changed in
Yeah.
what global sovereigns believe is collateral. So anyway, I thought that was really good.
Yeah, I think that's super well said. Like these are the big risks. Yes, if we get a classic recession, there could be a short blip downwards. But they have the tools to do it. They have a Fed funds that's way above neutral right now. They can cut a shit ton if they need to. They can turn off QT. They got plenty of tools to deal with a deflationary scare. What's the bigger issue, and this is what we're seeing again in these bond markets and gold markets, is that the bigger fear is, what happens if we see them lose control. What does that right tail risk look like?
Mhm.
That's why we like hard assets.
Yeah,
I mean, it's gonna happen, and the problem is when it happens again, there's not going to be the level of excess savings that existed post COVID stimulus, like it did in 22 and 23. They're not going to have the same leeway on draining an SPR that's already drained. They're not going to have the same leeway of strong arming their geopolitical opponents into peacetime during the election year, and inflation's going to be high again. So like, and unemployment rate's not going to be starting from a 3% trough. It's going to be starting from a 4.5-5% trough. So like,
yeah, they won't have that job vacancy buffer that they had last time that I was talking about. Things are bullish. SPY's hit a new all-time high again today. Gold's hitting new all-time highs every day. Bitcoin's on the verge of breaking out. We'll change our tune if we see it, but as it stands right now, it just looks like the Fed is cutting big into what looks like resilient growth to me.
Yep. And crypto, it's really reassuring that we were perplexed as to what was holding it down. It just was idiosyncratic supply. And next week, FTX creditors get, it's rumored $14 billion of cash back, which potentially could go back into the ecosystem. That's, a catalyst. Then you have Trump potentially, having a Bitcoin sovereign reserve. There's a lot of interesting things coming here into a rising global liquidity environment. So really hard to stay bearish.
Totally. All right, guys. Well, that was a great show. We'll let Quinn get to his 20th wedding of the year.
Have a beer.
I will.
All right, fellas.
Peace out.
Good stuff.
Yeah.